Hello, folks. Welcome to Market Trends. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone today. Going to start with a few disclosures as we always do. We'll also share a few links in the chat as we always do. All right. We'll also show you some standardized returns after this. Remember, we are going to potentially look at some ETFs, and we're going to show you the standardized returns for those. There is a link if you want to see the prospectuses for those. Here are the standardized returns for some ETFs we might be talking about. I should have this one on twice. There you go. All right. Now, go to tradestation.com. If you want to see, there's a blog post we're working off that has our information. Go to tradestation.com and click here on Insights. And then you're going to see there's a blog post that basically says, Gloom goes mainstream, has support become resistance. So I'm going to very quickly cover some of the points in here before we actually get into the technical side of things. And what was really interesting to me was it just kind of seems like a kind of pervasive sense of negativity becoming more kind of common. Now, people can say that's like a sign that it's near the end or something like that. You can think whatever, whichever way you want to take that overall perspective. But to me, the important thing to realize is it is becoming more kind of mainstream in terms of what strategists are saying and different sort of people. So what's interesting here is that Moody's basically is starting to warn about the American fiscal situation. Now, remember, Moody's is the only one of the rating agencies that does not have that has not yet reduced America from a AAA status. So you got to wonder if they're preparing, kind of laying the groundwork for a downgrade of the United States sovereign credit rating. Deutsche Bank now said there's a 43% chance of recession. And remember, it's kind of interesting that this economist, Janet Somm, she has a Somm rule, which basically says SAHM, by the way. Somm, she basically says that when unemployment jumps half a percentage point from its low, that's the sign a recession has started. It triggered last summer, never showed a recession. But remember, I think it's important to realize a lot of people have been saying we've been on a kind of recession watch for a while, so that in some ways it's possible those calls were early, but there are reasons when you look at something like that you could say there was certain groundwork of things that could become recessionary. So now to see other things lining up with that, something I think just to kind of bear in mind. Vanguard cut its GDP estimate. The Fed, remember, cut their GDP estimate. CNBC survey says 60% of CFOs see a recession this year, up from only 7% in the fourth quarter. And then you have to wonder if CFOs are saying gloomy things about the economy, are we going to get strong guidance when we start getting towards earnings season? Are we going to get weak guidance or something like that? Remember, the same people who make the guidance are those CFOs. So I think it's important to realize Barclays slashed their S&P forecast in an interesting way, and they basically said that their bear case has become the base case. It was kind of an interesting way to put it. And they're basically saying that tariffs are going to lower growth, lift inflation, and result in lower multiples overall. And it was also interesting that the chairman of Alibaba said that there's a potential bubble in data centers. So, I mean, just want to kind of point that out. Maybe a little bit of a negative in terms of some of the things that could be happening with, technology stocks and AI related things. So those are the main things. Now I'm going to go to some of the interesting things kind of popping up on the chart. I want to actually tell you guys, if you go up here to the very top, you can see that we have a new workspace that we're sharing called the 4-Chart Index Workspace. So I'm going to get to that in a second. So first, I want to go here to MTES, which I've given you guys before. Now, remember, MTES is in this initial one here, downloads available here. MTES has a custom indicator for the rate of change for the 50-hour moving average, which is what we're seeing here. Now, what's interesting is this gave a potential sell signal right here this morning. You can see that the 50-hour was falling and stochastic went overbought. I mean, that was also a potential sell signal there, kind of early, and then it spiked again. I mean, from that sell signal, it did proceed down, right? But then had a sharp snapback. It gave the sell signal again, and that was basically, 30, 40 points higher. So I just want to point out that this does remain some of the signals that, we've been looking at and you might find useful. So that's the S&P hourly of the futures. Now I want to point out something else. This is the cash index, and this is the other part. So this is basically just the cash index. You can't necessarily trade it the same way as futures. but I use it for charting purposes because you can see levels really nicely with this. So the first thing is this is the low from January, and you can see how it went up there and became, the high. Now we had basically, when the market was down here pulling back, we had talked about how there was that potential back on the 12th. We were talking about the potential for a snap back up to 57.73. We went up about 13 points above that. So basically, based on the kind of indicators we looked at, essentially the kind of expectation had been hit, and so that was something that kind of gave us a sense that Monday when we did State of the Market, we basically were talking about at this point it looked like the bounce had kind of worked its way out, and that's more or less what we've been seeing now. So it's interesting also, if you look at the entire drop, a 50% retracement of that was right here. Now, if you go on the Friday, which is another way, if you go to Friday the 21st, the textbook says with Fibonacci, you should go Friday. You should start on the Friday when the move begins, which would have put us right around here, I believe. And so basically, in that case, we went a little bit above 50% retracement. But I think regardless, we've, from my perspective here, this does give a pretty decent argument that, we have a kind of confirmation of the short-term trend, somewhat to the downside. Support became resistance, and then we also basically see we have essentially a 50% retracement of the entire move. But what's also interesting here, now if we hone in, I'm going to go to a 15-minute really quickly here, and what you can see is that if you look at it from the high on the 25th through the low today, look at how we went up and hit a 50% retracement. So what's interesting is the 50% retracements, if something goes a certain extent, retraces 50%, and then continues in the initial direction, it kind of confirms that that is your direction. So right here, what do we see? We basically see that we dropped, retraced 50%, and kind of continue lower. So these things are kind of continuing to point in the direction of weakness here. Now, of course, there's a lot of negativity in the market at this point in time. So you got to just, not push on a string, so to speak. But I wanted to just kind of share that, we did get some of these signals here. And at this point, there's obviously a lot of negativity. So I'm not necessarily clear of any signal at this moment, but it's interesting just to point out that these signals that we showed you here, these have continued to kind of give potential opportunities if you want to look. And the thing I've really been noticing is when the 50-hour is falling and stochastic goes overbought, that gives signals. And likewise to the upside. If the 50-hour is rising and stochastic goes oversold, that can also give signals like right here. That this was these were signals here. You can see the 50-hour was rising. You can see the green line rising. Stochastic goes oversold and the rebound happens. Stochastic goes oversold with the 50-hour, the line green, and up it goes. Then the line goes red. The 50-hour drops, hits that stochastic overbought, and both confirm pushes to the downside. So that's just an interesting little thing I like sharing with you guys. So that's how this workspace MTES can potentially work for you. Now I want to show you something else. This is another workspace I've done called MT4 chart index. And I want to just kind of share this because when you're, sometimes when you're in a volatile market like this, when you're trading futures, just different things become visible in different time frames. And what's interesting to me here is that this chart basically this is the same 60-minute chart that we have on the other one, but this is a 4-hour chart. And we set this to basically have this yellow line will mimic a 10-day simple moving average. The actual time frame on it, I don't even know what it is in terms of the number of days. But what it essentially does is it's designed, I don't want to get into it now, but I basically figured out how many 4-hour intervals would occur in a 10-day period. Now remember that this is futures, so it's not just 4-hour like in normal trading days. So anyway, I did the math, I figured it out, and I checked it, and this matches a 10-day simple moving average pretty closely. So I want to just kind of point this out, is that this will kind of allow you to see these things with these price channels. And it's interesting that you can see how the price channels here have actually worked pretty well for kind of spotting near-term turning points. We go up to that high, boom. Anyway, I want to just kind of point this out, that this is the 4-hour. This is I have it set for 5-minute and 15-minute. And what's interesting here, it gave a good signal today on the Russell small cap. Is it basically, if you look at Russell on the 15-minute, it gave a really interesting sort of signal how it went up, and you can see this level that was like from the overnight. It was around right here. My mouse is being slow, but you can see right here there's a signal from like 2 o'clock in the morning, And you can see how we rallied up to that and stalled there today. So this has been just a sort of interesting sort of thing as well to bear in mind. This is a 15-minute sort of chart, but this has multiple time frames, and it can kind of help you kind of focus. So I just flip around for the Nasdaq, the S&P, and the Russell on this to kind of look for levels and things that are happening. It's also good to think about if you're bearish, then you want to look for buy, short, potentially thinking about looking for overbought conditions, and then vice versa. If you're bullish, looking for oversold conditions. So the 5-minute RSI can help. To use these two on the left are designed to kind of give you your sense of should I be bullish or bearish, and then this one on the right is designed to kind of help where should I pull the trigger. So that's kind of what this workspace is for. All right, now also we have this other workspace I want to show, which basically, first of all, this is a chart we have in the today in our in the blog post if you actually look. And what's interesting to see is we have this all marked here, but you can see the 10-day is under the 20-day. Now, not all these moving averages are necessarily meaningful, but when they're all in a sequence, it can kind of give you a sense of trend. So here the 10-day is under the 20-day, which is under the 30-day, under the 50-day. So basically we see here from this whole kind of rainbow, there's ribbons of color that essentially the shorter moving averages are below the slower moving averages, and that confirms potential downtrend. You can see we hit that low here on the daily chart, and we also have the 21-day exponential, which a lot of people look at, that we're stalling at. That's what this orange line is here. So that's the same chart. We also see stochastic got up toward overbought, and that was also potential. That can be a signal as well that, stochastic has often been useful for finding overbought, oversold conditions. It moves more quickly than Wilder's RSI. Wilder's RSI can be difficult to really get overbought or oversold, and this can kind of give you signals more clearly sometimes. Now, this chart on the right, though, does have Wilder's RSI, and we've done this before. When we looked at how Wilder's RSI, which is this here, you can see when it goes to oversold. The lower study basically shows you the last condition of overbought or oversold that Wilder's RSI gave you. Now, why? What I believe is that for the daily chart, this is not true on hourly, but on the daily chart of the S&P 500, you can often find that Wilder's RSI will give you a significant signal on trend. So look back here to 2022 at the beginning of the bear market. Wilder's RSI went oversold, and then basically it created essentially a negative bearish trend for the next 18 months. And then you can see now it did go overbought there very briefly, and at that time, I mean, it might have marked in some ways that the real downtrend had ended. I mean, that was, you could say that was a contrary signal, but the key thing is that once things start going in a certain direction, like you can see here in June of 23, we went overbought, and it essentially kind of marked the beginning of an uptrend. And you can see here really clearly that when we got into late 2023, when we really started rallying off this low, we went overbought, and this indicator remained bullish for more than a year. So my perspective here would be, to a certain extent, that once you see this go oversold here, that actually can give a signal that the intermediate term trend, longer term trend now, is actually potentially pointing to the downside. And that's kind of what this indicator can kind of give you. And that's also what this EMA ribbons, which we showed you recently as well, shows, which is essentially that we had here, this when this crosses over and the faster moving average crosses under, it can kind of create a condition of a longer term sort of weakness. You can see at other pullbacks, it never really got under the way it has this time. And if you also look here at the beginning of the bear market back in 22, you can see also we had that cross under. And then if you look at other times, like it never crossed under. So anyway, those are some of the things I wanted to show you very quickly on the S&P 500. Now, I want to get to some other things here. If you go, as usual, we do have our trading view ideas. And I think it's interesting that today we actually did this analysis on the 10-year Treasury yield, and not analysis, but a charts kind of article. And what's interesting here is that there is some risk if we look on the 10-year that we are potentially really pushing to the upside. So one of the things here is that the 10-year Treasury yield. I'm going to just use a trading view chart because ever since they changed Windows, I've had trouble with my live data turned on and doing streaming. The two things get confused. So I'm going to look here. This is just a quick trading view chart. But we basically have, I'm going to turn off these inside-outside bars. But basically, this is a very significant level at kind of 4 32. It goes way back. We've talked about a lot. And you can see here that we basically held this level from December. And then there's also a downtrend over here that we kind of broke. So you can look at my trading view idea, but the key thing to me is that we're in a spot now that continues to be what I've kind of called the anti-Goldilocks. And what I mean by that is the economy now is not bad enough for the Fed to cut rates, but it's also in a spot where we're looking at potentially weaker profit margins, things like tariffs, things like these uncertainties that would argue in favor of lower multiples. So in some ways, it's the very opposite of a Goldilocks environment. And I think that's important to realize. And we're kind of seeing that in a lot of different things. We're seeing that in the fact that global continues to outperform. We're seeing it what's happening with precious metals and stuff like that. But I think to see treasury yields moving higher like this, it actually tells us that people are looking out and they're saying like, we're afraid of inflation. We're afraid of things like the deficit, and there's a lot of supply coming from the Treasury in terms of issuing debt soon and or later this year. And all those things right now, people are stepping back and they're seeing some other potential risk. I also want to show here that lumber prices. Look at this 5-year chart of lumber prices, and you can kind of see here that we are getting back toward these levels. Now, the thing about lumber is it's a very illiquid commodity. It's not really an asset at all. I mean, in terms of a financial asset, the bigger and bulkier a product is, the more volatile its price is. That's why silver is more expensive than gold, for example, because it costs more to store. So people are less likely to amass large amounts of it and all that sort of thing. Lumber obviously is a very big, bulky, and on overall inexpensive, which means it's more volatile, for its weight. And so the thing is that if lumber starts to jump, it could be in a spot where it could go up a lot. Now we have these tariffs coming from Canadian lumber and everything like that. So this creates an environment now where I'm kind of watching here for a potential jump in lumber prices, and I think that could start to also kind of scare people. So I want to just kind of point out when lumber starts pushing higher, we see 10-year treasury yield pushing higher. These are not great sort of things to be seeing happening. I think it continues to kind of weigh on sentiment overall, and just kind of know that a lot of these things are kind of potentially out there. Now, if we take a look over at, for example, gold, we can see that gold continues to push higher. It basically came down and tested 3,000 and continued higher. Silver, I think, remains very interesting for a potential breakout. We've talked about it before. And from my view, this is something now that we could really be seeing some potential upside. Look at how it held the 50% retracement right there of this move. So from my view here, silver is something that now could be on breakout watch to see if we get up above these highs from last October. This could be something where, if you look at it on the longer term chart, going back, this actually potentially has a lot of space where if it clears this level, a pretty sharp move toward 40 might be in the card. So I think we got to just realize here is that silver could be a pretty interesting sort of thing people could be focused on here. And it's interesting to see yields going higher and precious metals moving higher at the same time. It kind of suggests people are not buying treasuries and they're buying gold and silver instead. So that's interesting. I also think it's interesting I mean, it's not a highly traded thing, but this Indian bank, IBN, it's interesting to actually see that China is outperforming. Latin America is doing okay. Brazil is doing pretty well. And it's interesting to think about Asia. We looked at the situation with Trump and the tariffs on India, and like the amount of trade between the United States and India for the size of the Indian economy is quite small. So if people are starting to look for an economy that's growing, that doesn't have the risk of things like tariffs really hurting it, that's actually a country. So people might actually be starting to look at India again. So I think right now there's going to be, we're starting to see a lot of evidence of global outperformance. And we're also, I think, starting to see that there is a focus on Asia among all of these things. And, there's a lot of Asian ETFs and things like that we don't cover on this webinar, but I think it's important to realize they're out there. And there's a lot of evidence that that's actually where the strength is now. And that's where money seems to be moving. All right, so Goldman Sachs raised its target on gold from 3,100 to 3,300 because they say central banks just continue to buy gold. Okay, now, some other things I'm noticing. If you look on a trading view ideas, there are some interesting ones that really popped up. One of those is advanced micro devices. Now, this was one. I'm going to use a different chart that's a little bit cleaner. For example, AMD, we did a trading view idea on this one. And what's interesting on AMD is that this is like basically the chart. You can see it had this bearish outside candle, but look at how it had this level and it went up to an overbought condition and it's got slammed lower. So this was an interesting one. Now, if I look over on our workspace, I want to show you something. Now, remember, we have a bunch of custom indicators precisely for these sort of setups that I want to share with you. I'm going to hide myself so you can see them. All right, so look at how AMD went above these dotted lines, which is the Keltner channel. Now, if you go to MT main in the workspace we gave you, and then you go to, I think I have it in price grid, there's a thing here called Keltner pullback. Now, I'm going to just bring in, for example, the NASDAQ 100 to demonstrate this. Go to data and then import NASDAQ 100. The key thing is that AMD would have been lighting up Keltner pullback when it was up here, at like 115, 116. Before it had this drop, it was lighting up Keltner pullback. That's why I actually was looking at it. You had a flat line resistance at 116, which went over here, to this point in January, but you also had, it was above the Keltner channel. But the 50-hour was falling. So these are some of the things you can just kind of do is looking for opportunities. And another one that came up that's coming up to me right now that people might want to look at is Citi. Now, the financials have been relatively strong here, but if you look at Citi, it's had this, I was looking at this gap here on Citi, and it came up and hit that. And we also have a bearish outside day yesterday on Citi. The 8-day is under the 21-day exponential. And basically, it went up. It didn't get to the top of the Keltner channel, but it had a pretty good bounce. The regional banks, KRE, are in a similar situation. A lot of people are talking about issues with banks and loans and stuff like that. Now, there's always people warning that we're on the verge of a financial crisis and things if you read different things in the financial press. But it is interesting. The one thing I'll just say is that the main thing that hurt these banks was when interest rates went higher and the 10-year yield went higher. If you look at the real crisis these guys had back in early 23, almost 2 years ago now. Can you believe Silicon Valley Bank was almost 2 years ago? This sell-off here in February, March of 23, this happened when the 10-year Treasury yield was shooting higher. So look at that level. I'm going to go back on this weekly here, and you can basically see on this weekly, if we do TNX on TradeStation, you can see that that's also when the 10-year Treasury yield was starting to spike. See? And it had been running higher. See, it had this run higher, and then here it was. This was when the banking crisis happened. So basically, this run up in yields damaged their balance sheets, and it hurt these banks. So the thing is, if this 10-year continues to move higher, people might actually look for regional banks to go the other way. So I want to just kind of point that out. I'm not sure exactly the thing about this chart here, but I want to just point out that this is now also rebounded, stalling at the 200-day. The daily chart gives maybe better signals, stalling at the 200-day moving average, and then the 21-day exponential coming down. This could be viewed as a bearish flag, and there's a lot of other banks and financials that look the same way. There's a lot of kind of random cyclical stocks that have really broken down recently that in the last 2 weeks have had some decent rebounds that might be giving potential short kind of downside continuation opportunities. Another one is something like Capital One, COF, broke down kind of, I'm not going to take the time to do Fibonacci retracement on these. Some of these probably have about a 50% retracement of their drops. Same sort of thing. They snap back up, bearish outside day. That's in, COF. We did a trading view idea on Alcoa, AA. Now, despite tariffs on metals, we've noticed that the chart patterns are not screamingly bullish. And so this was just interesting. We had noticed this coming up, stalling at the 50-day. There's like a channel coming down there. It was overbought. You can see our trading view idea. We did it, I think, on Monday if you want to take a look. But again, all these year, we're seeing cyclicals. And the question is, all right, maybe we don't have a recession, but the economy goes from growing at 3% to growing at 0.5% or 1%. That is also not good for your classic cyclicals. If there's disruption in auto manufacturing or other manufacturing because of tariffs, also, that can slow the entire manufacturing process. So I want to just kind of point that out because overall, we're seeing a lot of these cyclicals have similar patterns. Look at American Airlines. Look at United Airlines. They have potential bearish flags on them. They had these really strong rallies late last year. They got slammed lower, and then they have a feeble bounce, and people see these potential sort of bearish flags in them. AAL, DAL. Also, airlines have a decent amount of debt. So actually, I'll tell you something else. Go to MT Main and now go to fundamentals. I'm going to bring in the S&P 500. Now could be the time to say, hey, if you got debt, maybe it's not so great. So let's go here. Let's bring in the whole S&P 500. Now, we have a special tool here called EV divided by market cap. And the higher that number is, it means the more leverage the company has. So you can also mix and match stuff. Well, actually, go to price grid now again. We populated this. So this actually shows the Keltner pullback tool. This right here. Now I'm on price grid on MT main. And if you look at this, this will actually show you when things are overbought or oversold. So if a Keltner pullback, the higher it is, it means the higher it is in the Keltner channel. So this one basically is above the top of this Keltner channel because it's 134%. Now that's a bullish chart, but, or at least people might think it's a bullish chart, but you can just kind of go down the list. And for example, AMD would have had a similarly overbought kind of condition not that long ago. You can just kind of go down the list and look at them. And I mean, I don't know, I'm just kind of sharing these. You can kind of think whatever you want about these, but the Keltner pullback allows you to find things that are, by one measure, overbought, and it's a potentially really simple, consistent way to do it. This is a tool we created for you guys. One of the great things you can do at TradeStation is to basically take an indicator and then kind of change it a little bit to make it useful. And the great thing about that is you can plug it into Radar Screen, and then you can sort by it. You can sort the entire S&P 500 or something. In this case, I have the entire NASDAQ in there. But you can look at some of these stocks like Cadence Design. It's a semiconductor software, semiconductor related company. I mean, look at that, up the top of the Keltner channel, but overall potentially bearish trend, had that gap down. I think that was earnings there. So if we look at this, this is one that just popped up now, for example. But this is a sort of thing that, again, a day or two ago, the Keltner pullback would have been over 100%. And that was a signal. And you can mix and match this with things like, okay, I want to find the ones that are under the 50-day, but the Keltner pullback is above 100. I want to find stocks that have a lot of debt, but the Keltner pullback is above 100. You can do all that by mixing and matching some of these indicators that we also have over here on fundamentals. So go back to fundamentals here. And if we look here at EV divided by market cap, this is going to tell us the companies that carry the most debt. You can see here that now it has a lot of banks, but it also has a company like Caesars, which is a cyclical company. It has a company here like General Motors, Ford, all these sort of things. So realize that this is going to, show banks and things like that by nature carry, use a lot of debt. But essentially, it's going to help you find stocks that are leveraged cyclical companies. And in a situation like this, with interest rates moving higher and potentially the economy slowing, leveraged cyclicals can be the ones that maybe perform to the downside. All right, so a couple of others that did also pop up when I was looking around this morning. Texas Instruments, we've been talking about how basically it, we were talking about up here, we said that, that with the overall weakness in semiconductors and stuff, it was a name that when it was up here, people were likely to drive it back down. And here again has a little bit of a bounce. People might see something in this, but one that really jumped out to me here, first of all, was Lam Research. Everything here in the chip space is, people could see potential risk. But I mean, this here, when you look at it, this has been kind of consolidating here. And if this breaks kind of much under 70, I mean, this could be something where people could really look for something LRCX to the downside potentially. And this has this, look at this failed double top here, kind of failed breakout under the old high. This could be setting up for, here, I mean, look, this is almost a year. I mean, this has been moving sideways now for like 7, 8, 9 months since really August of last year. So that's giving it plenty of time. Look at all these moving averages are close together here. It's giving plenty of time here for this to potentially turn into something more, to the downside. I mean, the pieces are potentially coming together in a name like this. People might want to be watching this one for a potential sort of break of this pattern. And some kind of continuation, looking for a move possibly under something like 70. So these are some of the things that were popping up for us. We actually found this one because of EMA test, 21-day EMA test, which is on our MA tools. If you put a stock into here, I'm not even using it. I have so many things I want to talk about, but this would light up on EMA test. So because it's hit the orange line. So for example, that's going to tell you stocks that are essentially at their short-term, intermediate-term kind of trend that may give an opportunity to continue to bounce off of that and then to continue in a certain direction. Now, I will mention that one name that's under the radar, but it's been popping up, is actually something that for tech stocks that has been holding up better than a lot, is OKTA, Okta. It's some kind of cybersecurity or something like that kind of a software company. But this is one that's been emerging now. And even if we are in a kind of bear market, say we do enter a bear market for growth in tech stocks, you'll often find one or two like stocks that perform, companies that people for some reason like, and sometimes they all flock to it. That happened with Alphabet back in like 2002, 2003, Google at the time, when all tech was bad and the only one that was good. And it's like, wow, if I'm a tech investor, the only thing that I can justify buying is Alphabet. And then you kind of get this weird thing when all of the kind of sad and depressed tech investors will throng to one stock. And I want to just point out that is a potential thing to think about. It's interesting to see the kind of breakout in Okta when everything else is struggling. I don't know very much about it. Okay, those are the main things I wanted to cover. The last thing I'll mention is that there is an IPO, some kind of cloud computing company called CoreWeave, and they actually cut the size of the IPO. It's just kind of something I want to briefly mention because it does also kind of show that there is that kind of languid lack of interest overall in tech. As I look down the list here, also remember we do have on April 2nd the big day of reciprocal tariffs. We have the end of the quarter on March 31st. So these are all things to kind of keep in mind. And Lulu reports this afternoon today. The thing I'll say about the end of the quarter is we start to get to the spot when there's a chance that people are going to start to see more negativity. I have been watching the S&P estimates, and they have been coming lower. And so all these here, I mean, I would say that on Tuesday, the ISM manufacturing report could be important because these have included price indexes, which have been all pointing higher. So I think it's important to realize here is that this is something that points toward potential degradation of profit margins we have to be aware of. So hope everyone has a great day. I will see you on Monday. Remember, on Monday, we do state of the market when we look at the sectors and the indexes. The link to it is right here if you want to check it out. Hope to see you guys on Monday. Don't forget also to check out some of the new workspaces we've shared, and I'll see you next week. Have a great weekend.